Bitcoin seems to have shaken the bear off its back, so it's time to look afresh at savvy ways to make crypto investing a profitable experience. However, before diving into the strategies for success, it is advisable to begin by assessing risk tolerance. There are four main areas to think about. Investors tend to underestimate risk in rising markets and overestimate risk in a falling market. Try to do the opposite. Make sure the amount of risk you're willing to take is aligned with your goals. The higher the return being sought, the greater the risk that has to be taken. Have in your mind a realistic timescale to meet your goals. It's very hard, if not impossible, to get rich quick. Age and disposable wealth will be a factor in working out how much risk you can take. The younger you are, the more time you have to make up for any losses. Now that you're happy with your risk profile, let's begin with the 10 strategies for success this year. 1. Smooth out volatility with dollar-pound cost averaging. Perhaps the most obvious feature of the crypto market is its volatility. That might seem surprising for anyone who has been following the price movement of Bitcoin over the past month or so. Its volatility narrowed considerably in March to a record low with a trading range of 7.8%, according to Dow Jones market data, until this week's breakout changed all that. Nevertheless, by the standards of established asset classes, 7.8% is still a high reading, and of course for other cryptoassets the volatility levels can be even greater. But here's the good news: crypto investors can smooth out volatility with a tried and tested strategy of drip-feeding cash into the market. By buying a set amount every month instead of taking a position with a large lump sum, investors will smooth volatility. 2. Portfolio diversification. Portfolio diversification is an essential strategy for all investors because it helps to mitigate risk. Basically, it never makes sense to put all your eggs in one basket, although Bitcoin maximalists are likely to disagree. There are several important ways to apply diversification. You could diversify with reference to the underlying technology of the various protocols, such as proof of work, proof of stake, and delegated proof of stake. 3. Investment theme strategy. Asset allocation theory holds that it is the mix of assets that is the key determinant of returns, not so much the specific holdings. Accordingly, for a traditional investor, it is the balance between stocks, bonds, commodities, cash, and alternative investments, for example, art, classic cars, stamps, and even crypto, that matters. We can drill down and apply this strategy to an investment universe that is confined to just crypto. The investor can then divide up the crypto world from the 2,134 cryptoassets listed on CoinMarketCap, or a more discrete selection, into proto-asset classes. In practice, what we are talking about here is essentially a sector breakdown. Investors can decide which sectors to hold on the basis of an investment theme. This in practice means taking a view on how you see the crypto economy developing. 4. Value investing with cryptoassets. In traditional finance, there is a split between so-called value and growth investing. Since the financial crisis of 2008, value investors haven't been doing that well. Such investors will typically focus on companies that they think are undervalued or are highly cash generative and are in the habit of returning value to shareholders through dividends and share buybacks. Growth investors look to a return primarily from an increase in the company share price. Applying that strategic approach to crypto rests on uncovering the undervalued cryptoassets. Before we move to the next step, do you want to discover a legit, fast, and easy way to make money with Bitcoin and cryptocurrencies? Visit the link in the description below to get started. 5. Smart holding. Crypto investors will be aware of the term holding. It is the crypto version of the mantra that applies in the mainstream markets known as the buy and hold strategy. 6. Crypto passive income. Some networks with proof-of-stake consensus protocols pay investors for staking coins. This is equivalent to getting paid interest for lending to an individual, company, or a government. The most important consideration here, as with bond investment, is the creditworthiness of the borrower. In other words, an investor ideally should stake in the busiest and most provenly secure blockchain networks. 7. Collective investment vehicles. Collective investment vehicles are instruments where multiple investors contribute in an investment vehicle, such as an investment trust, mutual fund, or exchange-traded fund. 8. Public companies with a crypto angle. Publicly listed companies with crypto and blockchain interests would until recently have led investors into the arms primarily of the graphic chip makers NVIDIA, Taiwan Semiconductor, and AMD. However, since the bear market set in, that hasn't been such a good play, but if we are at the bottom, then the chipmakers' crypto fortunes could reverse positively. Nevertheless, as a diversification strategy, there are other companies that could be part of a crypto portfolio. 9. Crypto asset picking using the Warren Buffett moat thesis. Legendary value investor Warren Buffett invests in stocks with a wide moat. By this he means companies with competitive advantages such as unique intellectual property or a captive audience that would be difficult for others to overcome. With that in mind, and the fact that we are talking about early-stage companies without substantial numbers of customers, the point of differentiation rests with those showing the most traction and with technologies that underpin a network capable of scaling securely. Out in front is Bitcoin because it has the largest network and the best name recognition in the marketplace, even if its protocol is not as scalable as newer proof-of-stake blockchains. 10. Be greedy when others are fearful. The time to start being greedy is either here or near, this strategy would suggest, but bear in mind the rule that you shouldn't put more than 2 to 5% of your net worth into alternative investments, of which crypto would be among other risky bets. And when you are ready to pounce, or at least to start drip-feeding cash into the market, work out your risk tolerance, do your own research and set your rules and targets and stick to them. Visit the link in the description below to access helpful recommendation to make money with cryptocurrencies.